Hey guys, welcome back to the channel. I appreciate you joining me today. I'm Richard Allen. Hey, if you're new here, consider subscribing. It's completely free and you can always change your mind. Thanks. In today's video, we're going to talk about buying dips as a strategy. With the craziness that has been going on in the stock market the last few days, it's a beautiful time to get into some of those stocks that you missed out on the run up. Now, this strategy does not replace any of my other investment strategies. This you would use in addition to value, growth, and dividend stocks, and also buy and hold investment strategies. As we talked about in the past, I'm just a YouTuber. I'm not a financial advisor. So take what we're saying today with the whole bag of salt, the whole bag. Buying dips can help you become rich in a couple different ways. Let's take a particular stock in your portfolio. Let's just use easy numbers. Let's say you bought into that stock at $100 per share. And it's a freaking bloody day in the stock market, and you just lost 12%. What do? Should you freak out? No, don't freak out. Especially not if you've been a smart investor and you're investing in a company that you're doing research on and it's a VGD stock that you believe in long term. If you've done your due diligence and you liked this stock at $100 per share, you have to love it at $88 per share. So what I would do in this situation is I would look at the 12% dip as an opportunity to buy in and bring the cost of my shares down. If you bought more shares at $88, you would be using an investment strategy called dollar cost averaging, or DCA. Now, DCA is way more complicated than buying dips, so we'll save that for another video. Speaking of another video, if you didn't already, click that beautiful red subscribe button down below. And let's get back into the video. In a previous video about how I almost lost my wife and my career because of day trading, I'll link that above and in the description below. We talked about how most investors react to dips in the market. They see a 12% dip in the market and they freak out and they let their emotions get the best of them. They think they made a terrible decision buying the stock when they did, and they irrationally sell out of their entire position at a 12% loss just to watch the stock rebound again and eventually make it to the price targets that they hoped for. Let me be clear, you could lose all of your money investing in individual companies, so you need to be careful and be prepared for red days in the market. If you make smart investment decisions and buy VGD stocks and use principles like dollar cost averaging, you could become rich by buying dips. So we talked about bringing down the average price of a position you already have, but what about a company that you're really excited about, but you're not invested in yet? Let's take Apple, for instance. Let's say you believe in Apple. It's a great value company, but you didn't want to buy it at all-time highs, so you've been hoping and waiting for a pullback. Let's say that pullback just happened, and over the previous 3 trading days, Apple drops 10%. What do? You buy. It's an opportunity to potentially make an instant 10% return on your investment, and you know in your hearts of hearts that this is a value company that will continue to grow over time, and you believe in Apple. In general, a good habit to get into is to only buy stocks on red days. This will teach you to look for a great deal on one of your favorite stocks, and you will be far less likely to feel that dreaded, horrible, terrifying feeling that is the fear of missing out. If you didn't invest this year, I promise that you felt the fear of missing out. Do you know why? Between March and August of this year, we had the biggest 100-day trading period since 1933. There are people that made a lot of money in that 100-day trading period. Now, for you, a lot of money could mean $1,000 extra in your bank account. Maybe it means another $10,000 in your bank account. Regardless of what a lot of money looks like to you, buying the dip in March would have been a great return on your investment. This is why I buy dips, and you should consider doing the same. My absolute favorite quote from Warren Buffett is, "Be greedy when others are fearful, and fearful when others are greedy." What that means to me is that when there is blood in the street, instead of contributing my own, I go out there and I accept donations. Because I know that no matter what, when people are done donating their blood, they're going back to the nurse's station to get more Oreos and orange juice to replenish their losses. And I'll be there waiting for them to donate again. Thank you so much for watching. Again, I'm Richard Allen. If you didn't already, click that beautiful red subscribe button down below, and I'll see you in the next one.